All right, I'm super excited today to get started with our inaugural episode of Amerifund Highlights of our loan officers. And so today I welcome our fellow Californian,
Hey.
Dion Sloan.
Hey, thanks for having me, Brad.
Yeah, man, I was super happy to see you come in the office today.
Absolutely.
You know, it's not often we get people that come in and visit us. We
Sure.
do have a few people that live in the neighborhood here, but you know, it was nice of you to take the drive up. And you're located where?
So I'm based out of Inland Empire, and then I also have a second property over in Long Beach. So,
Okay.
Yeah.
All right, and you're from Long Beach.
I'm initially from Long Beach.
And you're
area,
planning to
yes.
move back there soon.
Yeah, that's hometown. So
Okay,
absolutely.
right on.
Yeah.
Now, we just spent some time at the AIM Fuse event, which is our annual mortgage event in New Orleans this, I guess it was 2 weeks
Couple
ago.
weeks ago, yeah.
And give me your biggest takeaways from that.
Yeah, no, it was really good. Some great speakers really hit the stage. And I think one of the key takeaways for me was when Ed Milek got up there and he really emphasized the importance of just giving back to the community, you know, and really not just being so focused on the numbers and the day-to-day, but the reason why we do what we do. You know?
Yeah, and look, I find Ed to be compelling. Like every time I've seen him, it's extremely powerful. And I actually didn't know about him before my daughter told me about him at an event she was at. She
Okay.
was a part of Arbonne, and I think it was maybe about 5-6 years ago. And she
Okay.
came home and she was like, I just saw the most incredible speaker. And she told me who he was. I'm like, I don't even know who that is. And I
Yeah.
looked him up. I'm like, damn, he's really good.
He's
So
really
I,
good. Yeah.
I watch his podcast and that sort of thing, and it is really powerful. He really has, like he talked about in that, you know, in that presentation, he's got a deeper connection with people than most do.
Absolutely.
So yeah, that was very powerful. Look, we learned a lot at that event. We learned about the market that's coming up. We learned about where interest rates are expected to go. I mean, there's a lot of opportunity in the market.
Absolutely.
But what I think is most interesting that I'd like to concentrate on with you is your specialty.
Sure.
Because you concentrate your energy on people that are currently in default on their mortgages.
Yep.
So take a minute, and for those that don't understand what that means, and explain what it means to be in default on your mortgage.
Yep.
And then we can talk about solutions.
Yeah, for sure. So anytime someone's in a default status on their mortgage, it typically means that they're pending foreclosure. It's a pre-foreclosure status. So what that means is they haven't made their mortgage payment in 30 days. And so 30, 60, 90 days, they get a notice of default. And then at that point, that's the lender's opportunity to let the homeowner know that, hey, if you don't cure this default within a certain period of time, then we are going to file foreclosure status on your property, which means ultimately they lose their property, and not only just the property, but their equity in the home as well. So,
yeah, potentially equity. And right now, equity is in a all-time high.
Absolutely.
So you very well can find somebody who has lots of equity. They're house rich.
Correct.
But then they're
Cash
cash
poor.
poor,
Correct.
and they haven't been able to make their payments. If they don't make their payments, and this counts not only for the mortgage being in default, but also for taxes, because that's a
Correct.
common
Correct.
way to lose your home.
Absolutely.
And so what happens is somebody gets a notice of default.
Yep.
They're past 30 days. They're getting the phone calls. They're getting the emails. They're getting the letters in the mail. And then all of a sudden they're getting more phone calls, right?
Correct.
And maybe even people knocking on their door.
Absolutely.
Because everybody wants to get in touch with somebody who's in default because they want to be the one to tap into that person's equity
Correct.
and take a piece of their pie and
Exactly.
give them a small portion.
Sure.
So, you know, if somebody's in this position, they just don't have the resources.
Right.
They don't have a family member to help them out. They don't have reserves. They don't have a 401k. They don't have somebody to come in that's trusted, you know, that they can really rely on.
Exactly.
You know, what are their alternatives? Like, tell us what you do, because you have so many stories, and I want you to tell a couple of them, but you have so many stories where you have really changed people's lives because you've saved their equity.
Correct.
So tell us a little bit about it.
Correct. Yeah. So going back to what you're saying, Brad, you know, anytime someone's in a default status, that's typically public record, right? And so there's tons of investors, real estate agents, and the like trying to, you know, get in touch with this homeowner to get a deal or whatever the case might be, right? And so the homeowner, they're then struggling to understand who to trust because they have so many people coming at them from different directions. And there are a lot of sharks or crooked characters in that industry that ultimately don't mean well for the homeowner.
And honestly, most of these people are in a desperate position, and so they want to believe whatever
Correct.
story,
Correct.
and they just become completely vulnerable to these sharks.
Absolutely.
So definitely, if you're in that position, if you know somebody in that position, and you're not able to personally help them, how you can help them is to tell them to raise their awareness.
Exactly.
And really be concerned about who's trying to help them.
True. And so what my team and I do, we are certified foreclosure specialists. So we went through NAR, received the certification for short sales and pre-foreclosures, having to get a good understanding of the inner workings of the foreclosure so we can genuinely help them out. We actually have 14 different options, and we go down the list to actually help them either protect the home, the asset itself, or their equity. And so we go through those 14 different options to make sure that they fully are in the know of what their decisions or their options are so they can make an informed decision.
All right. So you're not going to get away with not talking about the 14 different options.
For sure.
Even if you have to pull them up on your laptop, you've got there.
They're here.
So I figured they probably were.
Yeah.
But tell us.
Yeah.
What are the 14 options?
Yeah, for sure. So going back to what you were saying, the first thing is if they have a family member or a friend who can help them cure that default, right? So let's say the delinquency on their mortgage is $10,000, $15,000. If they can come up with that money, they can pay that money back to the bank to reinstate their loan. And that's best case scenario, right? Typically when we talk to homeowners, that's not an option because if it were, they would have done that already, right? So reinstatement is always just the first option that we go through just to kind of let them know, hey.
Yeah, just in case they didn't know that.
Absolutely.
That they could catch it current.
Exactly. From there, we have loan modification. We can get in touch with the lender and let them know, hey, they have a financial hardship. We'll help them fill out a loss mitigation packet. And pretty much loan modification is ultimately qualifying for the loan again. They're looking at their debts. They're looking at their income. They're looking at the financial position of the borrower to see if they can actually qualify for this new restructured loan.
Right. So to drill down into that.
Sure.
Maybe your payment is $3,000 a month on your mortgage.
Correct.
And the reality is, your job went from full-time to part-time, whatever it is. You can afford to make some payments, but you can't afford to make the whole payment.
Exactly.
And mind you, if you don't make the whole payment, you're in default.
Yep, exactly.
So you could be making a partial payment and still be headed toward foreclosure.
Yeah, exactly.
But if you talk to the lender about modifying the loan, they may accept that lower payment.
Correct.
For some period of time, and it could be a long period of time. They could put the debt on the back of the mortgage,
correct,
of what you owe to them, let you get caught up. Maybe you find a new job, and now it's okay.
Correct.
So you can very much put yourself back in a position where you're in good standing with the lender.
Exactly.
It may have had a blip on your credit, but we can grow out of that.
Exactly.
So loan mod is number 2.
Yep.
All right, moving on.
Exactly.
Number 3.
So from there, we obviously we take that approach. Sometimes we, go with the bank and do the back and forth with them. They ask for additional documents. If it's not something that they qualify for, we'll go to the third option. And at that point, we can either do like a hard money loan, which would essentially pay off the first or, that entire loan that they have, if they have a first or a second, pay that off and then get them a new loan,
Okay.
And then oftentimes that's a 40-year amortized loan. Sometimes it's interest only to help keep the payments affordable as well. And that could be.
So I was going to ask you that. So chances are the loan that they currently have on the property is probably at a better interest rate than this hard money or private money loan.
Agreed.
But where they get the advantage is the interest only option.
Correct.
Which then allows them to have a lower payment. Yes, there's more of that payment.
Yep.
Or all of that payment going toward interest.
Correct.
But again, can buy them that stopgap
Exactly.
to put their life back on the road and then
they
get them into a
refinance out of
regular
it.
loan after.
Yep.
Got
Exactly.
it. All right,
Yep.
number 4.
Yeah, so then the fourth option depends on their age, right? So if they're 62 and up and they have enough equity in the property, a reverse mortgage is always a great option. Typically our senior citizens are on fixed income. They don't have the financial means to continue to pay on the mortgage. So we'll look at a reverse mortgage option, right?
I love that. Now, I'm a big fan of reverse mortgages. We have at Amerifund, we have a full reverse division called Reverse Loan Solutions. And I've been doing those loans since the 90s, so I know their value.
Agreed.
And the beautiful thing about reverse mortgages is you can be delinquent. You can be in foreclosure.
Correct.
It really is a matter of age and equity.
Correct.
Those are the two main qualifying factors.
Exactly.
Bear in mind that all you really need to be able to afford to pay are your taxes, your insurance, and maintaining the property.
Exactly.
That's it.
Yep.
So if you think about that, and 62 is the standard, but there are reverse mortgages that go as low as 55 years old, and you can get into a reverse mortgage. That's a permanent solution for the rest of your life. And when I say the rest of your life, until you die, you stay in that property as long as you're paying the taxes, the insurance, and maintaining the home.
Right.
And you've got to live in the property at least how long? A year? Do you know? Each year?
Talk to me.
You have to live in the property at least 181 days a year. Okay. So it has to be your primary residence.
Okay.
All right.
And some of the other benefits to the reverse mortgage, Brad, is that not only does it stop them from having to pay any monthly mortgage payment aside from the taxes and the insurance, but also they can get a lump sum of cash out. So let's say they're struggling financially, we can get them a lump sum of cash to take care of funds for a rainy day, or we can also give them a monthly distribution where we're getting them a check every month or a line of credit. So there's different features and benefits of the reverse mortgage that ultimately not only just cease the monthly payments, but also help provide income.
That's right. You have different options. It depends how much equity you have. And with interest rates coming down, the options, there are more options than there were before.
Exactly.
All right.
Exactly.
What's the fifth?
Yeah. So the fifth one would be, it depends on their situation, but sometimes they are short, right? I have a client right now.
Sometimes they're tall too. I mean, it's all kinds.
Right. So when I say short, I mean their loan balance is upside down compared to the value of the property.
Yes, they owe more on the property than it's worth.
Exactly.
Okay, which is a more rare circumstance today, but some people find themselves in that position because maybe they got a private money loan or somebody lent them money personally, but put a note on the property.
Right.
And so they had what they owed the mortgage company. Then they have what they owe this person.
Correct.
And they were kind enough to give them that money, but the value is less than that.
Yeah, exactly. Okay. And so if that situation were to arise, that would be what we call a short sale, right? And so at that point, we negotiate with the bank. We say, hey, will you settle or take less than what you actually, the mortgage balance is, in lieu of, letting the client or the homeowner walk away.
And what's the benefit of doing a short sale?
Yeah, so at that point, the foreclosure is no longer on the record. It's not on the record. But then also, oftentimes what we can negotiate with the bank is that they get cash for keys or relocation expenses. So then that way they do walk away with some money. They don't walk away with nothing. They don't walk away with the foreclosure on the record, but now they can get a fresh start.
Yeah, and so what somebody has to bear in mind when it comes to that is every state handles things a little bit differently.
True.
In judicial states, the process is different. In California specifically, which is our backyard, you will almost never find a lender that will go after you in court for a loss because they have a choice. They can either take the property or they can try and sue you.
Right.
That's it.
Right.
And chances are, if you're not making your mortgage payments, there's nothing to sue for.
Right.
So they take the property.
Exactly.
And it's like 99.99% of the time. But they know that that's better than some long, drawn-out process. And so if you're willing to actually say, look, I'm throwing in the towel.
Right.
But I need to have a little bit of cash to move. I need to be able to feed my family for the next 3 months.
Correct.
They may be willing to do that because the cost of the foreclosure exceeds the cost of just giving you a little bit of money and getting you out right away.
True.
Okay,
Agreed.
moving on.
Agreed.
Number 6.
Well, and to that point, I think that brings me to number 6 is the deed in lieu of foreclosure. So oftentimes we can negotiate with the bank and like you said, they wave their hands. I'm done with the property. I don't want this, asset, but I also don't want the foreclosure on my record. Yep. So sometimes the bank will accept the deed or the title in lieu of the foreclosure. They won't actually go through with the foreclosure.
Right. So the distinction there between that and the short sale is you probably have enough equity to cover the mortgage, but really not much more than that.
Right.
And so that you would do essentially the same process, but they're not taking a haircut on what you owe them.
Exactly.
Okay.
Exactly. And it's funny though, during the 2006, 2008 financial crisis, My dad actually took that same approach
The deed in
on
lieu.
one of his investment properties. He transferred title back to the bank and just wiped his hands
Very
clean.
common at that time.
Yeah, but
Very common.
it didn't impact his record, in terms of a
Look,
foreclosure.
it's a short heel, honestly, for your
Exactly.
credit.
Yep.
Within 4 years or so, you can be qualifying for mortgages and cars and all that again.
Exactly. Yep.
All right, number 7.
So number 7, there's two different options, right? 7 and 8. Bankruptcy, right?
Okay.
So the bankruptcy is always a good option to stop the foreclosure. There's different chapters of bankruptcy. So you have Chapter 7, which is usually used for like credit card debt, and it's over a certain loan amount. But then Chapter 13 is which is a restructure of the debt. And it's both of them stop the bankruptcy, but Chapter 13 you have about 5 years to repay on that debt. It consolidates it all, and ultimately you can kind of see yourself in a better financial position in the next 5 years or so.
An excellent option, especially if you're down at the very end of the road. They've done not only the notice of default, but there's a notice of sale, which is the next step, because the notice of sale is a date of foreclosure is set.
Yep.
So if you're in that position, it's like, where am I going to move? This is the most stressful period of time in your life.
Yep.
You can talk to a bankruptcy attorney and get them to at least give you some breathing room with
Correct.
that. Okay.
Correct.
That was 7 and 8.
That was 7
so
and 8.
number 9.
So then from there, we talk about, either listing the home. If you do have some equity in the property, let's go ahead and reinvest that into the next, asset. Let's not lose the equity. Let's list this property at market value. If you have the equity, great. We'll take that equity, your net proceeds, and we'll reinvest that into the next property.
I think that one stands out at me as probably the most common circumstance today.
True.
And it's because we've seen equity rise over the last 10 years. And somebody who finds themselves in the position of not being able to make their mortgage payment because of life circumstances, may have been medical, maybe all sorts of things, right?
Right.
Chances are they're sitting on equity.
Yeah.
But they've been so stressed out, they didn't know they had options. They haven't talked to somebody who can really advise them through this and give them the best options early on. So now they're in a pinch.
Correct.
And when they're in that pinch and the notice of default's been done and time is ticking, but they have this equity, the worst thing they could do is freeze up and lose that equity.
Agreed.
Right?
Agreed.
And so talking to somebody that can help them in doing the sale can also postpone the notice of sale.
Correct.
Meaning, if you, Dion, were to speak with somebody today who has equity in their property, can't make the mortgage payment, is 60 days down, you can get in touch with, on
trustee.
their behalf, as their agent, get in touch with the mortgage company and say, hey, look, I'm coming in. You guys don't have to foreclose on this.
Right.
Here's our business plan. We're going to list it for this. Here's how we can justify we're going to get it sold in a reasonable period of time.
Correct.
They have this much equity. You don't, because what people don't understand is if you do have equity, the bank doesn't benefit from that.
Right.
The bank can only get back what's owed plus their costs.
Correct.
And so that equity goes poof. And you know who gets it? The next buyer.
Yep.
Who buys it at the foreclosure sale.
The auction.
So these are investors, the auction. So so people knowing that, that knowledge is really powerful because you've got options.
Right.
You just need to talk to somebody who is a specialist like you are to help.
Yep.
And I know that you've got lots of stories like
Agreed.
that. All right, let's go through the rest of the 14.
Yeah, so to that point, so let's say a homeowner were to go through a foreclosure and they do have that equity. It's what we call a deficient surplus, right? And so essentially that we can actually come back and try to get that equity for the homeowner after the auction date.
Sale.
Correct.
Okay, explain how that works.
Yeah, so at that point, if let's say the property were sold in auction, we would go back and we would file a deficient surplus with the bank and let them know, hey, there was equity in the property, and this homeowner is due that surplus.
That's really interesting. That's something I'm not familiar with. And so, what happens with the investor that bought that home at auction at that price that basically has gained that equity?
Correct. That's the negotiation between the bank, the original homeowner, and that new investor or that new homeowner.
So if I'm an investor and I go to a foreclosure sale and I'm bidding on it and I get the property, let's just use some numbers here. Let's say the property today is worth $700,000. The person that got foreclosed on owed $500,000. I went to the auction. There are a couple bidders, and I get that property for $575,000. And I know that there's probably at least $50,000 of work I got to put in the property, but there's still equity.
Still equity,
right?
Right.
Why would I give any of that back? Am I obligated to do that?
They aren't. They aren't. And so that's the negotiation battle.
When you say negotiation, can you be successful at that? I mean, who would give that back? I bought it at auction.
Correct.
That's what I bought it for.
Correct. Yeah. And that's the conversation that we have with the new owner, and let them know, hey, this homeowner was going through a financial circumstance, and you try to do a little bit of a heart tug, like, hey,
have you been successful at that?
That's a great question. Some of my team members have.
Okay.
They have been successful in trying to get some of the equity back. Actually, right now, we've got a homeowner in San Bernardino County who's gone through the same thing. She, kind of unfortunately dragged, her feet, and property was sold at auction. And so now we're in touch with the new homeowner, and same thing, hey, there was a deficient judgment there, and at the end of the day, we need to try to get that money back.
Wow, that's interesting.
Yeah, so we're working on that one right now.
That's somebody who's really got to be charitable.
Yeah, okay. Exactly.
All right. So, but it's interesting that would be an approach. Okay, so what do we have next?
Yeah, so the other one is be like a gift of equity. And so let's say in this case there is equity in the property, and what they can do is, let's say they have a family member. Children, whatever the case might be, they can sell the house to their children, and essentially the equity that's in that property that can be gifted to the family member as a down payment. So that's another option that we present.
And you find that very commonly on FHA loans. So the person that you want to give the house to really can't afford the down payment, but they can afford the payments.
Correct.
And so you can, as a family member, and it could be a niece, a nephew, an uncle, you can gift them that equity, which becomes their down payment.
Correct.
So at least it stays in the family, and you have that money to go move into an apartment or wherever it is that makes sense for you.
Exactly.
So that's good. Okay, another option. I think we're on 12 or 13.
12, yeah.
Okay.
So from there, we can also do, this was really big during COVID, was the forbearance options. We would reach out to the bank, let them know, hey, can we file for forbearance, which means a deferment of the monthly payments. So and they usually give maybe 30, 60, 90 days, sometimes up to like 6 months of deferred payments. So that's a relief, but it depends on the bank and also what's going on in the economy, right? That was big during
COVID. It was a big thing.
COVID was big, right?
Hey, I've lost my job right now.
Correct.
Okay. And there was obviously some government involvement and so forth with the creditors, but you might find somebody in forbearance for 6 months to a year. We saw that on credit reports regularly.
Correct.
So, all right. And then the last one.
And then the last option. So this is more of an investor strategy, but it's also like more cash for keys. And then we would reinstate the loan and, take over the mortgage subject to the existing financing.
I just did a video on subject to.
Okay.
And so let's let people know what that means. So subject to. So I'm the buyer, you're the seller.
Yep.
If I'm buying subject to, what does that mean?
So as the buyer, essentially you would take title, you would take ownership rights to the property, but the mortgage that's in my name as the original homeowner would remain consistent. So the terms, the monthly payments, all of those details stay in place, and ultimately you assume that loan. You take over the monthly payments on my behalf.
Yes. Okay. So let's go a little bit deeper on this one because there's some questions in it.
Sure.
Right? So I'm the investor. I'm coming in. I'm saying I'm going to buy this subject to. You've got some equity. I maybe say, hey, look, Dion, you're not going to be able to make these payments. You're 60 days down. You're going to have your notice of sale soon. I'll buy it as is. You don't need to do anything to the property. I'll give you. You've got what we figure is going to be about $40,000 of equity, but the property needs about $20,000 of work.
Correct.
So I'll give you $10,000 cash. Gives you the ability to move.
Relocate.
We're going to leave the loan in your name. I'm going to catch it current, meaning I'm going to pay what's in arrears, and I promise to make the payments on that.
Correct.
What happens if I don't make those payments?
So that's a great question. So what happens if that new homeowner doesn't make the monthly payments? Then ultimately the borrower is responsible for that in terms of their credit. So the way we also can structure that is we put like a reserve account or an escrow account where those monies are sitting there and it just automatically pays the monthly payment. So then that way the homeowner is a little bit more assured that the money's already there and they're not risking,
So it's a little bit of a cautionary tale
is.
with that. However, I will tell you, most investors that do come in, buy it subject to, they're more than good for it.
Okay,
Especially
exactly.
if you can set yourself up so they give you some cash up front
Yep.
and then maybe give you a little bit of the upside when they sell it, because they're typically flippers.
Exactly.
And so if you've got 40,000, or let's just say a bigger number there, because let's say you've got $100,000 of equity, but you are $20,000 behind on your mortgage. That's a cost to the buyer coming in. So they're going to be into it for 20. They're going to be into it for what they fix it up. But then once they fix it up, maybe there's another 150,000 of equity.
For the appreciation.
Maybe they give you a bonus of another 20 grand.
Yep.
Right?
Yep.
And so if you can do it that way, that might be the best option for you
Agreed.
if you don't have any other options.
Agreed. Yeah, joint venture between the investor and the homeowner. Yeah.
That's right.
Agreed.
Okay.
Yeah.
Well, cool, man. That's a lot of really good information.
Yeah.
And we're going to have to lay this out nicely on the video.
Absolutely.
All right. So tell us at least one good story of somebody that you saved and what it meant to them.
Yeah, for sure. So I was dealing with this homeowner. She actually had two properties. One was her primary, one was an investment. And surprisingly, both of them were in the default status. And so we reached out to her, door knocked her, left a flyer. She called us. She's like, hey, I need your help. I've been dealing with some other people and they really haven't helped me too much, just real estate agents, so forward. And so we got in touch with her, did a little sit down in her living room, broke down a couple of different strategies for her, and found out that actually in her case, the hard money option was going to be the best bet. So we did a hard money on both her investment property and her primary, and ultimately just helped save both homes for her. And she was looking to give one to her daughter. The investment property had been in the family for years. It was something that her mother purchased, back in like the, early 70s. And so ultimately she had the equity there. It was a sentimental value to her because it had been in the family. She was looking to take that and give that to her daughter. And so we were able to help her out with both homes and, get her out of that situation. Now, our goal that was actually just a few months ago, is I've got her in credit repair right now. So we're getting her credit cleaned up. And so once that's, to a point where she can qualify for traditional financing, the goal is to get her out of those hard money loans, We even did, there was enough equity in the property because she was concerned about the monthly payment for the hard money, right? We ended up doing a cash advance or advance payments. So we were able to take out some money from the equity so she didn't actually have to make those monthly payments on her own.
Didn't have to stress about that.
Exactly.
Very good.
Exactly.
That sounds very good.
Yeah.
That leads me to think of really kind of another option, and that is cross-collateralization. So if somebody owns more than one property and maybe they are struggling to make the payments, but there's equity in a different property,
Correct.
There are loans that can be done that collateralize or basically take the one property's equity and apply it to the other without moving the money, but just by creating a deed that covers both.
Agreed.
Right?
Yep.
So
yep.
Add that. That's number 15. All right. Very good. Look, Dion, thanks for coming in the office today and
Absolutely.
being the very first one on our loan officer profile.
Yeah.
Dude, we're just so excited to have you with us.
I'm excited
You're
to
a
be
real
here.
pro.
Yep.
You're out there doing really great things, really helping people. And
Absolutely.
I see
Yep.
you posting online and telling the stories and even having your clients and your borrowers and your videos.
Exactly. Yep.
If people want to reach you, if they're in trouble,
Sure.
where can they find you?
Yeah, so you can reach me on any of my social platforms. Dion Sloan _broker is my Instagram. Dion Sloan is my Facebook. Or you can even give me a call. My direct line is 909-255-6339.
Awesome. Or go to Amerifund.com and search for Dion Sloan. You'll find a webpage for him there with all his information as well. Thanks for joining us today.
Thanks for having me, Brad.